So a very good evening to our audience today. So very excited to see that we have such a great turnout for tonight's webinar. I'm Rebecca, and I'll be your host for tonight's episode of our Ask Me Anything webinar series. So tonight we are going to find out more on how to supercharge your SRS. So why this particular topic tonight? So I'm very sure many of us here are familiar with the Supplementary Retirement Scheme, SRS, and the Central Provident Fund, CPF. But how many of us truly understand the full potential of these tools in planning for retirement? We all know that building a secure financial future takes time, knowledge, and a solid plan. When it comes to retirement planning, integrating SRS with CPF and personal savings can seem complex, but with the right approach, it can create a strong foundation for lasting financial stability and peace of mind. Let's dive in and explore how you can make full use of these resources for a secure and fulfilling retirement. So I'm sure everyone has some burning questions for tonight. Before we get started, may I request that you type your questions in the bottom Q&A button, and the speakers will come to it at the end when we have our Q&A segment. And for the audience, we are currently live on our Zoom and Facebook as well. Before I introduce our guest for tonight, I must assure all of you that there will be no selling during tonight's webinar, so we are keeping it completely educational. Let's keep this session lighthearted, sit back and relax and enjoy your time here while the speakers share some of their thoughts and views. If you are watching us, please share this with your other friends whom you think will benefit from this fireside chat as well, where you can ask all your questions about how to supercharge your SRS live to our very own financial specialists. All right, so I'm very thrilled to introduce our three panelists for the night with very different life and industry experiences and perspectives. They are Sophia Tan, Ho Ka Wei, and Darius Foo. So each speaker will provide their unique viewpoints and experience for tonight's topic. So let's look forward to that. So introducing our very first speaker of the night, with over 12 years of experience, which is very impressive. Let's hear more from our wealth manager, Sophia. So Sophia, would you like to introduce yourself to everyone?
Thank you. Good evening, Rebecca, and good evening to everyone who's tuning in. Thank you for inviting me. I'm Sophia. For me, it's my mission to empower individuals to see their goals through with planning as well as wealth management. And I think being here adds to my mission. And as I was formerly a teacher, I believe in financial education. And I've also written articles specifically on SRS and strategies on optimizing it. Back to you, Rebecca.
Thank you, Sophia, for the warm introduction. It's, really fascinating to learn that in addition to your 12 years of expertise in wealth planning and management, you also bring the perspective of a former educator. So I completely agree that financial literacy is essential, and I'm sure the audience is looking forward to learning more from you tonight. Now let's welcome our second speaker. We have Ka Wei here with us today. So Ka Wei, with a wealth experience of in the financial advisory industry since 2015. He brings, valuable insights, and I'm very confident that we'll gain a great deal from his expertise tonight. So hi, Ka Wei, would you like to share more about yourself with our audience?
Hello, everyone. Yeah, thank you for having me today. I think across all industries, especially the financial industry, evolves ever so quickly. So it's important for me to be ahead of the pack so that I can value add my clients. For today's topic, like SRS is increasingly more applicable to the demographics of the people that I meet, as well as the clients that I serve. So I'm excited for what's to come for this webinar. Hopefully you'll be able to gain some valuable insights after tonight.
Okay, thank you. Awesome. So thank you, Ka Wei, for the introduction. I believe our audience here tonight is as excited as I am to be able to learn more from you. Okay, so last but not least, we have a very special guest speaker for the evening. We have Darius, Senior Director of Distribution Business at Lion Global Investors, who brings over 20 years of experience in the financial industry. So, how exciting is it to have him here with us today, right, to share valuable tips on our topic. So, Darius, would you like to say hi to everyone?
Hi everyone. Thanks for having me, and very happy to be here together with Sophia, Ka Wei, and yourself, Rebecca. I think among the four of us, I should be the oldest probably in the room, and the one that will probably utilize my SRS the soonest among the four of us. Yeah. So with that, happy to hear tips from Sophia and Ka Wei as well, so that I can deploy my SRS as soon as possible.
Thank you, Darius, for the introduction. So yeah, looking forward to your sharing tonight as well. Okay, so that's the introduction of all of our panelists here tonight. So, of course, before we dive into the first question of the night, let's take a moment to look at this article over here from the Business Times titled SRS contributions are great for tax savings, but may not be for everyone. So, of course, in Singapore, the majority of the population is familiar with the Central Provident Fund, CPF, as mentioned earlier, and its various schemes. However, many Singaporeans may know little about the SRS, so let alone participate in this. So while the SRS encourages individuals to save for retirement by offering tax benefits, to what extent is it suitable for everyone? Should we consider placing all of our money into SRS accounts to reduce our tax burden? So maybe we can start with Sophia, to ask her to share her thoughts with us and insights on this article.
Thanks, Rebecca. So with regard to the article, I do agree that SRS are great for tax savings, but it may not be for everyone. For example, it was mentioned that for someone who has just joined the workforce, putting funds into the SRS may not see significant savings from tax. So it would actually make more sense when you earn more, let's say, for example, more than 100K a year. Then after it becomes a planning question. Are there near-term cash needs or big ticket purchases coming up? So that you will not want to withdraw your funds too early. This is because premature withdrawals will result in penalties as well as taxes incurred. Yeah, and so you don't want to have to pay more taxes later on.
Okay, thank you, Sophia, for the insightful perspective on this article. Now, while we know that SRS is not suitable for everyone and may not be the best option, keeping these points in mind, let's explore in this webinar on how you can better decide if SRS aligns with your financial goals and circumstances. So before we go on to the first question of the night, let's find out a little bit about our audience today. We are very curious, who's attending our webinar. So our first poll of the night, which life stage am I at? So we have 4 options over here. The first one, we have new graduate, if you have just started out working. And then the second option, we have married without kids, married with kids, and golden age. Okay, so let's see what our audience thinks tonight. I think we'll give it 1 or 2 minutes. So if you are on Facebook, you can comment in the chat box on your answer. If you are on Zoom, you can simply just click your answer over here where you are. We will just wait for about 1 to 2 minutes for the results to come in. Okay. So looks like I think most of our audience over here actually chose married with kids, and then many of you are also in your golden stage, but very interesting. So let's find out more tonight with these results, yeah? Okay, so just to start off our first question of the evening, what is SRS, the Supplementary Retirement Scheme? So maybe we can get Kawe to share with us first.
Yeah, sure. So for the Supplementary Retirement Scheme is a voluntary program in Singapore designed to help individuals save for their retirement. It's managed by the Singapore government and complements the Central Provident Fund, which we all know as CPF. The contributions to SRS are eligible for tax relief, and the investment returns are also accumulated tax-free. However, do bear in mind that 50% of the withdrawals from SRS are taxable once you reach the statutory retirement age. How about you, Darius?
Thanks, Kawe. I think given that you and Sophia are the financial planners, I'll leave all the tax questions and all that or comments to the two of you. So let me come from asset management kind of a perspective. So I like to see SRS as part of our overall pot of money. So obviously we have the monies, the cash that we have in our banks and all that. We also have CPF OA, CPF SA, and then we have the SRS. So I see SRS as kind of like the fourth pool of money if you contribute as per what Sophia has mentioned previously, if it benefits you, as the last pool of money that you can possibly tap on for your investing needs as well. And here, I guess the one thing that I want to say as the asset management firm on this panel is that a lot of people forget, they take it as the tax savings thing that y'all talked about, right? And they park their money there and then they leave it there, forgetting that actually the interest is only 0.05%, but you have a whole spectrum and gamut of things that you can actually invest into. Yeah. Maybe Sophia, you have something to add?
Yes, thanks, Darius. So we do want to be able to share that. So SRS offers a twofold advantage. So we can save on taxes, and of course, just like what Darius said, we can supercharge it for our retirement goals. And there's also one more good news that even foreigners can contribute towards SRS. Back to you, Rebecca.
Okay, thank you, speakers, for sharing about the SRS. So, although this might seem like a basic question to us, right? But I think it is undoubtedly essential to understand the importance of SRS and how it helps individuals in Singapore plan effectively for retirement while taking advantage of tax savings and other benefits as well. Okay, so now let's move on to our next question. What's the difference between SRS and CPF? So maybe this one we can get Darius to start first.
Okay, so I guess as I mentioned earlier on, to us as asset management firm, it's like another pool of money that you can essentially tap on, right? And here I perhaps see the difference between CPF and SRS more in terms of the usage of your money. So for example, with CPF monies, you can park it aside, you can use it for payment of your house. I think in some instances you can even use it to offset some of your children's education. Obviously, the child has to pay back, etc., unless the parent writes it off. So I would say that from LGI's perspective, it's just yet another pool of money, but the differences probably lie in terms of the usage. Whereas SRS, as I think both my esteemed panelists have already mentioned, is something that you park aside and you probably can't see it until very, very further down the road when you intend to retire and draw upon it. The only one thing I want to say is that, again, when you compare CPF and SRS, at least your CPF OA gets you 2.5%, your SA gets you 4%, right? SRS only gets you 0.05%. So it's really quite little and definitely not enough to beat inflation, even if you're contributing across a long period of time. Maybe one of my other panelists would like to comment on the differences.
Sure. Thanks, Darius. So maybe I'll do like a little bit of a compare and contrast. So SRS would be like a voluntary scheme, whereas CPF would be a compulsory one. And of course, CPF are meant to provide for housing, medical needs, and basic living needs after retirement, whereas SRS is solely meant for retirement. And of course, for CPF, just like what Darius has mentioned, you can invest, with the ordinary or special account. But as the special account already offers a 4% per annum, so we may decide to utilize the OA funds a bit more. And just like Darius mentioned, as SRS only offers 0.05%, it becomes really an opportunity cost not investing with it. And what's also interesting for SRS is that compared to CPF, SRS, there's a lot more instruments that can be invested with. And so it's almost like having another pot of cash to invest with, allowing for greater flexibility as well as potential with various asset classes. Kawe, what do you think?
I think just to add one more point, withdrawals from CPF can start from 55 once and then again at 65, where your CPF life pays out starts. Versus withdrawals from SRS technically can occur anytime, just that prior to the retirement age, it will be subjected to 5% penalty fee and 100% tax on the withdrawal amount as mentioned earlier.
Okay, thank you, speakers, for breaking down the differences between CPF and SRS. So I'm sure all of you understand better on the difference between the two already. So I know I did. So now that we know that understanding the differences enables individuals like yourself to make smarter choices about, saving, investing, and of course, in managing your finances as well. So this will definitely help to pave, our way to a well-prepared retirement. So moving on, let's start our second poll for the night. So over here we have the question: have you topped up your your SRS, sorry, contributions before? So we have yes, no, and I don't have an SRS account. So if you are on Facebook, you can comment in the chat box on your answer. And again, if you are on Zoom, you can simply just click your answer and we shall wait, 1 to 2 minutes for the results to come in. So I think now many people are leaning towards yes, they have topped up their SRS contributions before. Okay, so the final results, yeah, we can see that 75% of you have topped up your SRS contributions before, and then we have another 16% who states that they do not have a SRS account. Okay, so maybe we can move on to our next question to understand a little bit more from our speakers on this. Okay, so following our second poll to understand if our audience tonight has topped up their SRS contributions before. So I believe this question will be incredibly helpful, for those who have already done so. Question is, what should I consider before making additional SRS contributions? So, I mean, even if you have yet to top up your SRS, do listen closely because this could be your sign to start paying a little bit more attention to your SRS, right? So let's get Sophia to, start sharing for this question first.
Thanks. So of course, there are undeniable benefits utilizing the SRS. And of course, the tax benefit will be even more significant when you're in a higher tax bracket. You can also consider, say, for example, other retirement vehicles. Compare SRS with other retirement savings and investment options, such as CPF top-ups. Again, that has a different set of restrictions and benefits, as well as private investments. And of course, diversification as well. Ensure that you have retirement savings that are diversified, which means CPF, SRS, and other personal savings and investment vehicles. That's to actually reduce the dependence on just one income source upon retirement. And of course, by carefully assessing your tax position, investment options, as well as retirement needs, you can determine if SRS top-ups align with your long-term financial goals, because this will help you to maximize the benefits of SRS while ensuring that it will serve as an effective part of your retirement planning strategy. So do seek the advice of a professional like us for your planning needs. Howie?
I think to add on other considerations such as the flexibility and accessibility to these funds, do you see yourself needing access to these funds down the road before the statutory retirement age for other purposes such as housing, family planning, etc.? Because if you do, you'll incur a 5% penalty fee and 100% of the withdrawal amount will be subjected to tax if you were to withdraw it prematurely. And secondly would be the tax effect. For example, by contributing to SRS, how much taxes will you actually save? And by doing so, will it result you to drop to a lower tier in the tax bracket? Yeah. So the last point would be, what is the opportunity cost here? Is it worthwhile compared to other investment options available in the market?
Okay, thank you, Kawe. Thanks, Sophia, as well. So for sharing these insightful points for consideration. So with that in mind, let's move on. Let's now move on and discuss how you can make the most out of your SRS as part of your broader retirement planning. Okay, so I think we will also be moving on to our final poll of the night. So, we have our final poll over here. Are you making the most of your SRS savings? So we have 4 options here. The first one being yes, but I want to learn about more options. The second option, not really. I'm not sure how to invest it. And the third one, I'm still figuring out what's best for my age. And the last one would be no, I haven't invested my SRS savings yet. So again, if you are on Facebook, you can comment in the chat box on your answer. If you are on Zoom, you can just simply click your answer. Okay, so we shall wait another 1 to 2 minutes for the results to come in. Okay. Okay, so I think we see that around half of you, actually 50%, says yes, but I want to learn about more options, right, on how you can make the most out of your SRS savings. And then we have another half half of you that says also, I'm still figuring out what's best for my age. So I think let's move on to the further questions, right? So that we can you can find out how to make the most out of your SRS savings. Okay, so the next question. So now that we know, if our audience here tonight is fully maximizing your SRS savings, our next question would be, what are the best options for investing my SRS savings? So I'm sure everyone here is very curious, right, to learn more about this. So let's just get into it. So maybe Darius, would you like to share first?
Sure. Thanks, Rebecca. I think, as I think it was Sophia who mentioned earlier on that, with SRS, you have a bigger pool of investments that you can actually explore and look at. Coming from an asset management company perspective, I think LGI, we will just probably comment on some of the stuff that we have, which is mostly things like unit trust funds as well as ETFs, right? So I won't talk about stocks and all these other things. I'll leave it to the others to maybe mention it if they like. And so when you look at unit trust funds as well as ETFs, I think the big comparison obviously is, do you want somebody that's actively managing it for you, or do you want an ETF, which is basically like a passive index, maybe lower in cost, but you kind of know what kind of performance you're going to get out of it. But the other thing about investing in whether you're looking at unit trust funds or ETF is also because when you're looking at the whole sum of your entire, financial needs and planning. And this is again money, CPF, SRS. When you're looking at funds, it offers you a lot more diversification. Vis-a-vis, if you've taken all that money and you just bought a single fund or a single stock or a single bond. Perhaps, right? The other thing about buying the unit trust funds as well as ETFs is you could potentially get better diversification as well. So if you bought a global multi-asset fund, for example, you're getting global bonds, global equities as well. And vis-a-vis, if you're buying into Asia, you're getting a diversified spread across all different Asian countries. The other aspect that some investors also forget is that, if you actually buy into certain funds and ETFs, you're also getting certain stylistics as well. So this also could be blending it together with what your financial goals and needs are. So again, that could be some members of the audience. They are halfway through their career, so in terms of that goalpost of 55 or 65, whichever when you want to get the money, there's still maybe another 10, 15 years to go. So as a result, perhaps you can look at more adventurous stuff like, higher risk, kind of unit trust funds or ETF. But then again, if it doesn't suit your style, you could possibly buy things like fixed income and things like that. Or if you are, the other group that's already mentioning that they are in their golden era as well, right? So they could potentially, invest their SRS into funds that actually yield them an income. Right. So this is all part and parcel of what your overall financial goals and financial needs are. And the last thing that I wanted to say is though is funds and ETFs, they are very, very useful as tools because the barrier of entry is very, very low. So in order to buy a fund, for example, you only need $100 every month if you're doing it on a regular basis, or $1,000 for a lump sum as well. So even though, and some people might forget that because end of the day, there is a cap, right, to the SRS and the benefits of, contributing to the SRS. So you're not talking about putting 10, 20, 30,000. Obviously, unless you've been putting it for many, many years and you haven't done anything, then suddenly you're sitting on $100,000, for example. But if you've been consistently doing it, it's actually probably looking like $10,000, $12,000 a year. So it's stuff that you can essentially look at slightly longer term, growth assets to help grow your money for when you finally want to withdraw it and draw down on it. Yeah. Maybe I'll pass it to Kawe or Sophia to talk about the next points that pertaining to, financial planning aspect.
Okay. Yeah. So for myself, when I plan for my clients, I think at the end of the day, it's always about the end goal in mind. Since SRS is typically meant for their retirement, the key factor here is the risk and volatility they can stomach. So for example, my clients who are younger in their 20s to 30s, I would say they can afford to take on more risk. Since there is a long time horizon that they can at least ride through 2 to 3 market cycles before they need to draw down from their SRS account. For my clients who are nearing their retirement in their 40s to 60s, then I would say, for example, fixed income bonds or annuities would be more suitable for them so that they don't see too much drawdown in the event of market conditions are not favorable. Yeah. How about you, Sophia?
Thank you, Kawe. I think to me, this becomes like a planning question because everyone's needs, like financial goals, as you mentioned, timeline, financial capacity, and risk tolerance, etc., are all a bit different. So I do agree for someone who's young and have a high tolerance for volatility, they can typically afford to take on more investment risk to maximize growth. So perhaps like stocks, unit trusts, and certain ETFs would be a better option. However, even if someone who is younger and have a longer timeline and have already met the goals that they want, they may not need to tolerate as much risk or volatility, and so can even consider like what you mentioned earlier, fixed income, REITs, bonds for more capital preservation needs instead. Yeah. However, I also think that even for someone who might have a shorter timeline, for example, someone who is a bit older, if there is a huge gap still towards your goals, the portfolio should still be skewed towards growth. Back to you, Rebecca.
Okay, thank you to our speakers for sharing these insightful points. So I think ultimately, aligning your investments with your unique needs is key to achieving financial success, right? So I think let's move on to explore how to integrate your SRS with other retirement strategies. Okay, so on to our next question. How can I integrate my SRS with other retirement strategies? Example, your CPF, your personal savings. So maybe this one we can get Kawi to share with us first.
Yes. So for SRS, as is termed as a supplementary retirement scheme, can be one option to complement CPF Life, which pays out a lifetime income for Singaporeans from 65 onwards, for as long as they live. Yeah, it can also complement your own investments that you have done during your prime working years, to ensure that you can achieve the passive income, to support the quality of life that you wish to have. As highlighted earlier, SRS funds can be withdrawn over a period of 10 years from the retirement age that is locked in based on the individual. So right now, currently it's at 63. It can be early as 62. And this can form part of your income generating strategy for your retirement years. What are your thoughts, Sophia?
Thank you, Kawe. As mentioned earlier, and I think it's also good to say this again, and just in case you have joined us, so SRS can be integrated with CPF Life. So CPF Life provides that guaranteed lifelong income, while SRS withdrawals can be staggered to complement the CPF payouts. And you can also arrange the withdrawals in a way over 10 years so that you don't pay any taxes on them at all. And of course, some SRS funds can also be used to purchase annuities or other retirement income products that pay you a steady stream of income. Since only 50% of the income is taxable, this strategy allows you to enjoy tax-efficient income during retirement. And some annuities are also specifically designed for SRS funds, so offering a guaranteed payout and also helping you to plan for a steady cash flow during your retirement years. How about yourself, Darius?
Okay, I think since Kawe and yourself, you guys have been talking about how to integrate that together with CPF Life and to provide a steady flow of income and all to sustain their current standard of lifestyles and all these others. I think maybe what we can then switch gears a little bit and talk about is how investments and particularly even maybe LGI funds, right, could be used for yet another goal or retirement aspirations. So maybe allow me to digress a slight bit, but over at LGI, we've also talked a bit about, we've launched our own retirement campaign as well, where we talk about capital preservation. And so I think there's a portion of people who will need a certain sum of money, and this could be their only sum of money, and so they cannot afford to lose it, right? So I don't think these are the kind of clients that are in this call tonight because obviously they are exploring SRS, so they are on the other quantum. And so what you guys have just talked about is a little bit on the income part. There's also one of our retirement goals in terms of our campaign. One aspect, though, I think that you all both didn't quite touch on, where I like to add some color, is in legacy planning, right? Because if you're combining that with CPF Life and you're drawing a regular income and all that, daily expenses, your livelihood, maybe go and travel, go and do this and that. But hopefully, most of our audience members tonight, by the time they get to draw down on their SRS and all, they will be very, very comfortable with the income that they have generated. And this is now really deemed as excess cash, right? And so then I think that this group of people, their SRS and all that, can be also used to be a more growth orientated kind of a instrument to grow their monies further, not because they are leaving it to their children, but maybe even for their grandchildren, right? To take care of the next generation's needs and aspirations as well. So I think this is one way that people can look at their SRS that, hey, if I done all the other things well, this becomes a legacy planning. But yes, if I missed up some goals, some targets and all that, then this becomes my emergency spare pot of recovery. Yeah. Back to you,
Thank you, Darius. Thanks, speakers, for sharing other retirement strategies as well. So I'm sure our audience tonight understand these strategies a little bit better. So moving on to our next question, over here we have what are the penalties and benefits of SRS withdrawals? So I think even for myself, I'm not very sure, right? So I think we want to get the speakers to share a little bit more on this. Maybe we can get Kawi to share more with us first.
Okay, I'll be covering on the penalties involved. Yeah. So as we mentioned throughout the webinar, if you were to withdraw before the statutory retirement age, 100% of the withdrawal amount would be subjected to tax, and also on top of that, a 5% penalty fee. This will ultimately add on to your taxable income for the year itself, and it might also result you in hitting a higher tax bracket because of that. Yeah, so therefore, by withdrawing your funds prematurely, you lose the benefit of the tax-deferred compounding within the SRS account, and this can significantly reduce the growth potential of your investments. Yeah, I'll get Sophia to share on the benefits.
Thank you. So we can look at the benefits as well. What happens is the SRS let us it does what we call it tax deferrals. So it allows you to defer the tax on contributions until retirement, often when your income as well as tax rate is lower, which will result in tax savings. Okay. So in terms of tax efficient income in retirement, because only 50% of the withdrawals are taxable after retirement age, that will reduce your tax liability. So in order to have this tax, okay, so I think there's the table there now. So by planning these withdrawals very carefully, you can manage the tax impact as well as maintain more retirement income. So when we see from the very first of the table, 20K will be taxed. So what happens is that there will be no penalty for withdrawals made after the statutory retirement age. And therefore, when you withdraw 40K after the retirement age, you will pay no taxes because that's calculated at 50% of the withdrawals. And of course, you can also spread that withdrawals over 10 years from the date of your first withdrawal after your retirement age, so that will help you to manage the tax exposure each year. Okay, and of course, there's also flexibility in the investment and withdrawal. So unlike CPF, SRS funds can be invested in a range of assets, and you can also choose how and when you want to withdraw them post-retirement, so allowing for more flexible financial planning. So at the end of the day, we want to really be able to plan for the best as well as prepare for the worst.
Okay, thanks speakers for sharing on this question. So I'm sure our audience, have a better understanding of the penalties and the benefits of SRS withdrawals now. And, don't worry if, to all of you over here with us tonight, if you need a refresher after this session, because, a recording of this webinar will be uploaded onto our official YouTube page. So do look out for that. Okay, so before we move on to our Q&A session, we would like to welcome you to connect with our PhillipCapital or with any of our financial specialists here tonight if you would like to know more about tonight's topic or any other questions related to your financial well-being. So feel free to reach out to any of our panelists here by scanning their QR code. So I'm sure from tonight we can see that our speakers are always very generous in sharing, value-added financial tips to their clients and their followers. So they are also expanding their team and welcome like-minded individuals to explore more with them. So for those who are also enjoying webinars like this one and would like to stay connected with us to receive more updates, do give us a like and follow us on our Facebook and Instagram page at Phillip Wealth Advisory as well. Okay, so now for the very exciting part of the night, let's get on with our Q&A section. So let me just maybe check the tab to see if we have see which questions we'll get our panelists to answer. Okay, so I think I have a question here by Mark. To qualify for statutory retirement age at 62, is this based on the calendar year when I turn 62 years old? Must it be past my actual birth date on that year? So for IRAS calculating my 50% tax benefit, it is prorated on my birthday month for 62 years old for that year. Sorry. Maybe this one we can get Kawi to take a look at this question. I think he'll be able to answer this question. Yeah.
Okay. Yeah, so I do see, Mark, you asked two questions. I'll just briefly touch on your first question. I think that one Sophia already mentioned. But just to reiterate, as you can see, based on the tax table, because 50% of your withdrawals will be taxed. That's why people withdraw 40K every year, because half of it is 20K, and 20K based on the tax bracket is zero, like you don't pay any tax for it. Yeah. Then for your second question, is actually based on when you open your SRS account. So if you opened your SRS account before July the 1st of 2022, it will be locked in at 62. So if you open your SRS account after July 1st, 2022, it will be 63.
Okay, thank you, Kawi. Okay, I think the next question we have over here, maybe we can get Darius to answer this question because it's related to investments. So the question is, what sort of investments are actually suitable for consideration for SRS in particular?
Okay, I guess it depends really how old the person is, perhaps. But maybe let me take a step back from that. I think the challenge with our industry today is that a lot of times we bucket or we pocket investments and we tie that to age groups. I like to think of it nowadays as more goal orientated because you may be, for example, in your 50 years old, right? But then your goal could be capital preservation, as I talked about earlier. That means this pot of money cannot lose on. That's all I have. That's it, no more. But yeah, at the same time, there could be a 50-year-old person that needs income, for example, or for that matter, that 50-year-old has way too much money and is now looking at legacy planning and all that. So all these will differ. So maybe if I were to just touch on a couple of them. So let's say you are really low risk or you are in that conservation kind of a bucket. That means you're actually not low risk, but you can't afford to take any more risk. There's always things like short duration bond funds that you can look at. So these are instruments that invest in like bonds that are between 1 to 3 years. And given the current climate that we're in, we know interest rates have hiked up quite a fair bit. These are still instruments that yield you a very decent 3 to 4%, way better than the 0.05 that SRS is giving you if you had just left it there. But at the same time, if you are a little bit more of a risk taker and you can take a bit of a 50-50 kind of a portfolio, then there are multi-asset funds out there that you can actually invest in, and these will be a mixture of bonds as well as equities. And some of all these types of products may also give you an income stream anywhere from 3%, 4%, 5%. On the other hand, if you are also looking at long term, as I remember Kawi was saying it just now, you could potentially put it into equities, full on equities like Japanese equities, for example, or even our good old Singapore equities. It's been proven to grow 5% over the course of 10 years for a long period of time. So I think, it really depends what age group you are in, as well as what kind of risk tolerance you have, because that determines your investment horizons and the risk that you're willing to take as well. Yeah.
Thank you, Darius. Thanks. Okay, I think maybe we'll take a couple more questions. We have one from Chet Siu Cheng, I think. She says, my SRS money used to buy annuities will be taxed when I passed away. Maybe this one we can get Sophia. Do you want to take this question?
Okay, so with regard to, let's say, for example, annuities, right? So what happens is that as long as you continue to receive those for life, 50% of the annuity payments will still be subject to tax each year. Yeah.
Okay, thank you, Sophia. Okay, another question over here by Jing Yang. The question is, I expect myself to work beyond 62, so how can I reduce the tax I pay on drawouts? And what happens after the 10 years? Maybe this one we can get Kawi to answer.
Okay. So for your question, right, Zinya, I think if let's say you're talking about the withdrawals can happen anytime after beyond the statutory retirement age. So doesn't mean you lock in at 62 means the payout will start at 62, whether you like it or not. Yeah, it can start, let's say, at 65, and then the 10 years start from there. Yeah, so if you're talking about, let's say, reducing the tax, that's why based on the withdrawal amount, ideally is 40K per year, so you pay no tax. Yeah, but let's say if your account, if you really diligently contribute every year and also based on the tools that you invest your SRS funds into, and the account grows to a sizable amount, let's say if at the end of the 10th year, you have to withdraw everything. Yeah. So let's say at that point in time, then you have to strategize, let's say, based on how much your account has grown, how to minimize the impact. Yeah. If not, let's say the remainder, when you withdraw out on the 10th year itself, then based on what we have shared earlier, 50% of that will be taxed. So then you have to see which tax bracket, which tier you will fall under on the last year.
Okay, thank you, Kawi.
Rebecca. Hi,
Yes.
Rebecca. Can I throw in another thought about what was just being asked as well?
Yeah, of course.
So I was on another similar panel talking about SRS, and it's very interesting because Kawi talked about that 40,000 limit, right? So we all think about taxation from the perspective that when we contribute, we want to pay less tax when we're earning income, and then when we draw out the money, we want to pay no tax because that was the whole idea. But what was interesting was I was on another panel, and somebody else also gave another perspective, right? That hey, actually, if you grow your money, let's say to 500,000 or 600,000, right, and then across 10 years, then that means unfortunately, you are not below that 40,000 mark, and you do incur some taxation at that point in time, right? That person gave a suggestion to say, look, you could still also take 50,000, 60,000, but then that extra amount of money, right? Why don't you contribute it to your child's CPF OA? And then, you may not personally get a tax deduction per se, but you may actually help your child get a tax deduction or save money from that aspect. So for all you know, on your own, yes, you're getting taxed, but when you plus minus with your children, you could actually get some kind of tax efficiencies, right? And lower their tax bracket and all that as well, which I thought was very interesting. I didn't have time to work out the mathematics, but there seems to be some kind of logic there because they were saying some numbers like you pay X amount of money, but you help your child save X amount of money in sheer numbers that might actually help and benefit them as well. But again, I'll defer to the two experts on this panel. But I thought that was just an interesting viewpoint. Yeah.
Thank you. Thanks, Darius, for sharing that with us. Okay, I think we have another question here by an anonymous attendee. Is SRS relief subjected to the $80,000 cap? So this one, Sophia, would you like to take this question?
Yes, so the SRS relief is subjected to the $80,000 cap. Yeah, and I think I also take another question. Yeah, there was one in which that the question is asking.
Yes. Yeah. So we have another question over here, by anonymous attendee as well. The question is, since we are only earning 0.05% in SRS in our SRS account, is it advisable to use SRS funds to buy in T-bill? Right?
Yes. So with regard to this, I feel that because SRS is locked in for a longer period of time. So if, let's say, for example, we do have the risk appetite for it, actually, I would actually look at it, maybe, looking at buying other sort of instruments instead into other asset classes like equities, for example. Yeah. But of course, if let's say for, during times when the interest rates are high, then of course you could also deploy it for T-bills. Yeah.
Okay,
Thanks.
thank you, Sophia. Yeah, okay. So maybe we'll take a couple more questions before we move on. I think over here we have a pretty interesting question here, also by anonymous attendee, that I would like to ask Darius, because I think he would probably know the answer. This person asked to give a list of recommended investments for a 50-year-old. So how would you recommend this person?
Okay. So that's why I was kind of trying to allude to in the answer earlier on. I don't think there's a specific list of funds. And because I work for LGI, I might be very, very biased to say that the top 10 are all LGI funds. But I think I want to just go back again to rehash my point, right? It really depends what your investment goal is. And maybe it's worth explaining a little bit why in constructing that whole retirement campaign we talk about capital preservation, blah 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 and all that. Because what happened was really one day I was driving to work and across the radio there was this news report about how this man he had no more family and all these other relatives and all and unfortunately for him, he didn't plan well for retirement. So the only option he had was to sell back a portion of his HDB lease to the government, and they gave him some $300,000, right? But that is where his $300,000 is. I cannot lose this money one because if I lose this money, that's it. I've got nothing left. So that to us forms the basis of your capital preservation. So it could be because you're in that same situation, you cannot lose that money, or maybe you're really very, very risk adverse, right? Then in that case, your top 10 might include even like what Sophia said, maybe T-bills, if the interest rate is right. Or it might be, some of the fixed income instruments like, to give out a shout out to our own short duration bond fund, for example, we obviously have a fund that pays out anywhere from 4% on average. Now, maybe as yields are coming down a little bit, it's 3.7, so on and so forth, right? But yeah, at the same time, there are a lot of other money market funds out there as well. There are a lot of enhanced liquidity funds. These are all cash-like instruments, which are very, very safe, very secure. The large part of all these funds also buys into T-bills and all that, as well as places monies in banks, fixed deposits. So if you're really low risk, I would say those are good instruments to invest into. As mentioned again, if you're a little bit more adventurous and you are willing to take on a bit more risk, then there's multi-asset products that you can look at investing your SRS into. There's one, obviously, again, just to name shamelessly shout out LGI Fund, we have this fund called the All Seasons Fund. All Seasons is a multi-asset fund, but what is more interesting about this multi-asset fund is we try to buy into ETFs as well. So in this particular product, we're not trying to be excellent stock pickers, but what we're trying to do is be asset allocators. So if we like the US, we buy more of this S&P 500 ETF, so on and so forth. But the beauty of this is that the cost is low. So at LGI, we opt to cap the cost at 0.5%. Right, so that's all you pay on total expense. So fund management fee, fund fees, etc., etc. And this to me is a good fund as well because if you're talking about SRS, as Sophia mentioned, it's locked in. You can't do anything about it anyway. Then you will want to buy into a low cost instrument that helps you save on fees, but yet at the same time build your long-term portfolio. But again, just to echo what my fellow panelists have all said as well, if you're a bit more daring and all that, use it to buy stocks, use it to buy equity funds, and then obviously the world is your oyster, right? You can pick anything from China, US, etc., to essentially put your SRS monies into. Yeah, hopefully that helps.
Okay, thank you, Darius. Hopefully, yeah, that helps. I'm sure that helps your answer. But I think I wanted to take I think P Kwan Go. You've asked that if we'll be able to flash the speaker's contact afterwards. I think don't worry about that. We will definitely flash the all of our the contact details for our panelists later on before we end off the webinar. So yeah, stay tuned for that. And then maybe we will take one or two more questions and then we will move on. Okay. So I think over here we have one more question from an anonymous attendee as well. For foreigners, how would their SRS be taxed if they decide to leave Singapore at the age of 65? So this one, I think maybe we can get Kawe to answer it.
Okay. Yeah. So for same thing, foreigners will still be taxed also. But your contribution is higher, right? 35,700 per year. Yeah. So you need to also hold your account for at least 10 years. Then you'll be taxed 50% on the withdrawal amount. Yeah.
Okay, thank you for that, Kawi. Okay, I think we have one more last question that we'll take. Sophia, you want to take this question from Subrata, I think. It is advisable to set aside SRS when there's a 7% tax bracket. Do you understand this question?
Yes.
Mm.
So which means that what you're earning now is actually at the 7% tax bracket. So as I think there was a question earlier with regard to whether SRS is for everyone. So because if let's say for example I'm not earning a very high income, so what happens is that if I do set aside SRS, and this is actually, let's say for example we have just started working not too long ago, it may mean that I will accumulate too much SRS. Because if it goes beyond a certain amount, it will mean that when I want to take it out later and even spread over 10 years, I will get taxed. So we don't want to end up with a situation in which that we are taxed even more later on. Yeah. So, and of course, when we are at 7%, 7% in terms of the tax bracket, it would mean that if I'm going to put aside for the amount into SRS, it will also impact cash flow as well. Yeah. So there are quite a few things to look at. Yeah. And of course, at that point in time, there isn't the tax savings is not very high too. Yeah. So you may want to think about it and whether is that the best allocation for your funds at this point in time.
Okay, thank you, Sophia. Okay, I think we'll take one last question, okay, by Mark over here. So, the question is, what happens to my unwithdrawn SRS funds if I pass away prematurely? Do I need to write a will to cover it? Just as my will to cover my money in my bank account. So maybe this one, Kawi, would you like to take this question?
Okay. Yeah. So upon death, right, any sum remaining in the SRS account will be deemed to be withdrawn at that point in time. Yeah, so that one will also be added on to your chargeable income. Then as what we mentioned, 50% of it will be taxed.
Okay, thank you, Kawi. Thanks, speakers, for all of your refreshing answers. I hope that that answers all of your questions to the audience here tonight. If we have not answered your questions, don't worry about this. We will be sending out a email, EDM out, with the unanswered questions. So do stay tuned for that as well. Okay, so now let's wrap things up by getting our speakers to share some final tips with us. So I think maybe let's start with Darius. Any final tips for our audience here tonight?
Yeah, I think other than the fact that once you start contributing your SRS, please don't forget to make it a habit. So often do it so that you can get whatever kind of tax relief that you can get off your financial planning. But the more important thing is also invest your SRS. Make it a habit. Don't just leave it down there and just earn 0.05 because then you will really be just leaving it there and not fully utilizing the power of compounding. Because again, most of us, you would have maybe started deploying a little bit into SRS from the age of 30, 35, or what have you, and all the way to retirement. That's actually more than 20 over years, right? So if you do invest, even at a very low interest rate, 3% or 5% rate of return, you can actually snowball that money into quite a substantial sum of a pot of money when you actually do start to draw it out. So don't forget to make it a habit to actually invest your monies. Yeah.
Okay, what about you, Sophia? Any final tips?
Sure. I think as what Darius mentioned just now, do make sure that you're getting your money to work hard for you. Okay. And then as we've got to starting your SRS, of course, there are times in which that we see online, there are many tips about, open your SRS account with $1. But just now, as mentioned, some of the times we may end up with too much money in the SRS account too early. Yeah, so we do want to actually be able to plan that out. Yeah, and of course, with regard to making your money work hard for you, the last tip I have is to start it now. Do it now. Thanks.
Thank you, Sophia. Okay, we have our last panelist, Kawi. What about you? Do you have any final tips for our audience?
Yeah, so I think throughout the whole night we've been talking about the SRS account. So I think, like we said, there's also one option to help you to generate your wealth. Yeah, so I think it's more importantly of not how much we earn, but how much surplus that we have and how we also allocate it to build income generating assets for ourselves. And as cliche as it may sound, if you fail to plan, you plan to fail. Yeah. So definitely the financial decisions that you make throughout your life will have an imperative impact on the quality of life that you have for yourself.
Thank you, Kawi. Thanks, Darius and Sophia as well for, very insightful final tips for our audience here today. Okay, so all right, so now that we have covered, all about tonight's topic. I hope everyone here has benefited from tonight's webinar, and we'll have some ideas on how exactly to supercharge your SRS. So I think once again, you may connect with any of our panelists here tonight if you wish to understand more about any financial related matters. So we have come to the end of tonight's session. I would like to thank our three expert speakers for their unreserved and open sharing, and also a big thank you to everyone who has stayed, here with us so far. Do join us for our future Ask Me Anything episodes as well. We'll love to have you here again. So this is Rebecca signing off, and see you and good night. Thank you, everyone.
Thank you. Good night. Bye-bye.
Thank you.